Hi everyone, my name's Darryl Panes, CEO of As Good as Gold Australia. And this evening, once again, I'm joined by my brother Brian and partner at As Good as Gold. And tonight we speak with Alasdair Macleod. Alasdair has been working in the financial world since 1970, has been a member of the London Stock Exchange for nearly 5 decades. He is head of research for GoldMoney and is a very strong advocate for sound money. Alasdair is regularly interviewed at King World News, as well as many other premier networks such as CNBC, and of course was recently appointed advisor to As Good as Gold Australia. Good evening, Alasdair.
Good evening, Alasdair.
Good evening.
Good to connect again. We've got a very big date coming up, Alasdair, the 28th of June. Very important date for gold silver investors. Probably a more important date than any that they've experienced over the last few years, most certainly. On the 28th of June, we have a major development occurring, Basel III. So Basel III is an internationally agreed set of measures developed by the Basel Committee on banking supervision in response to the financial crisis going back, of course, 2007 through 2009. Now, Alasdair, could you share with our viewers what you believe will be the outcome from this event?
I think the bit that you're referring to in particular is the rules and regulations around something completely new, and that is the net stable funding ratio. Now, this is introduced basically to ensure that the bank's financing of their balance sheets on the liabilities side broadly matches what they call the same tenor, in other words, the same sort of maturities on the asset side, because what you don't want to have is money sort of running out of the door on the liabilities side while you can't sell the assets on the other side. Then you have a problem, and potentially it's a problem that can escalate from bank to bank to bank, because you've got all these interbank relationships, which ensures that the problem in one bank can rapidly become a problem in the other. So the answer to this was the net stable funding ratio, and this is not new. It was first proposed in the spring. I think the first paper on it from the committee came out in the spring of 2014. And the wording of it was finally agreed in October 2014. That's the date of the original paper. But it's only, the introduction of it has been delayed and delayed and delayed. And now we've got to the point where the Europeans in the European Union, we're not just talking the Eurozone, we're also talking banks outside the Eurozone, but within the European Union, are now going to comply with this from the 28th of June, which is the date you referred to. Also, the American banks will be applying from the 1st of July, exactly the same rules. And in the UK, these are going to be introduced at the very end of this year. Technically, it's the 1st or 2nd of January, 2022. The reason this has really come up is because the LBMA wrote a letter to the regulator when the regulator asked for comments, describing what the net stable funding ratio would do to the bullion banks in the London bullion market. And the letter, I have to say, was full of, I suppose I would call them, well, I don't know whether they're unforced or forced errors. There were quite a few errors. They were describing unallocated gold as if it was gold. It is not, and they should know better. But the other thing that came out of it was that it was quite clear that the restrictions of the net stable funding ratio would mean that it would be impossible to run the central clearing system, which is basically it's an operation owned by I think 4 of the largest banks who effectively fund it. And not only that, but it would mean that banks could not run uneven positions without having to pay significant penalties. Now, the reason this comes about is that you can't automatically match off a specific type of asset on one side of your balance sheet with another. Now, bear in mind that the way the banks account is they use double entry bookkeeping. And this goes all the way back to banking law, which was created in the wake of the 1844 Bank Charter Act, which was known as Peel's Charter Act. The legal precedents were set following that. And what this basically means is that if a bank, let us say, claims that it has a gold liability, and this would be an unallocated gold liability. In other words, it will be a liability in the currency of the bank in which it accounts, but tied to the price of gold. In other words, it's a dollar liability, but tied to the price of gold. It's unallocated. It is not gold. I mean, the amount of unallocated gold in London, I mean, there would be evidence of it being stored everywhere, but I can tell you, there's none. It does not actually exist. It's rather like betting on a horse. I mean, you can put money on a horse, but, it's a figure of speech putting money on the horse. If the horse comes in and wins, the bookie pays you out. The horse has got nothing to do with the transaction. So that is the situation with unallocated gold. Right. Because unallocated gold can be closed in an account like that, and because the Basel Committee recognizes that anyone who has an account with a bank, a gold account, which is an unallocated account, can withdraw their money just like that. So you cannot use that as part of your funding for the other side of your balance sheet, for your assets. So if, let us say, you have got, sort of positions both ways, then immediately the sum of your balance sheet, which you can't use to fund the rest of your balance sheet on the other side. So this is a very inefficient use of liabilities to finance assets. That's the first point. The second point is that when it comes to the required stable funding, which applies to the asset side, then gold positions require funding from the liabilities to the tune of 85% of the value of the asset. So in other words, there's a 15% haircut. You've got to have a margin over. And not only that, but you can't use the gold on the other side, your pretend gold on the other side of your balance sheet. It is quite clear that Basel has seen through the charade of unallocated gold. And so they should, because the Bank of International Settlements is a very big trader in gold, both physical and also in derivatives. So what this means is that in London, at the end of this year, basically, the bullion banks are going to be withdrawing from the market. I mean, they can continue. There's nothing to stop them continuing, but there is a penalty for them continuing in terms of the management of their balance sheet. And it's very hard to see how the Treasury Department in a bank is going to look with favor on gold traders who run uneven positions. This assumes the best translation of the rules possible. And that is, if you've got an identifiable position on this side of your balance sheet, which you can match definitely with something on this side of your balance sheet, then you could probably end up with a net position, which you then need to address within the context of the net stable funding ratio. It's rather like, when you look at COMEX, you have got naked longs, naked shorts, and then you have got other positions where basically, for example, a swap or a hedge fund might say, sell a gold contract for one maturity to buy another, stripping out the difference in price, because it's probably got a funding benefit on it. Now, so those are clearly matched. In Europe, it seems that the Swiss are trying to push for their banks to run clearly matched positions on that sort of basis. It is not clear at this stage that that is going to be the exact position for unallocated gold, unallocated silver, unallocated oil, unallocated copper, and all the other commodities that are traded this way with banks acting as counterparties. On the LBMA, there are 43 banking members, and the majority of those, the vast majority of those, will be running not just positions for clients, customers. If your banks have customers rather than clients, brokers have clients. Anyway, small technical point. Not only do they run positions for their customers, like a customer says, I want to buy some gold. Can you go into the market and buy some for me? Now, they can buy it either as physical gold, in which case it's meant to be stored in custody, not on the bank's balance sheet. Or what they usually do is they say, look, it's far more cost effective for you to hold a gold position in unallocated gold, because we don't have to charge you anything. Oh, well, I'll go unallocated. So that's one side of the business. The other side of the business is trading. And what will happen is you've got these guys sitting on a desk, so-called experts in the gold market, handling customer orders. Why not give them discretion to run a 100 million position? And, we'll give them profit targets at the end of every quarter. And that explains a lot of the ups and downs we're seeing. And incidentally, as I'm talking, in the last day or two, the price of gold has fallen $100. And it's fallen $100 because we're coming up to the end of the quarter. And the position has been most conveniently created by an interpretation of the FOMC minutes, which came out yesterday. Anyway, at the end of every quarter, you do tend to see these sort of sell-offs. Basically. Why? Because the traders who are short, the bullion bank traders who are short, want to demonstrate, for the purpose of their bonuses, their bosses, their treasury departments, whatever, the best possible position at the end of the quarter. That's what we're seeing, basically. Anyway, I digress slightly. You've got 43 of these bullion banks who are members of the LBMA. At the end of this calendar year, they will be, I think it's right to assume they will be out of the market. Meanwhile, on COMEX, you've got exactly the same position. Most of the people who trade in London also trade in COMEX. And the COMEX gold contract, basically there are two sides of it. They define it as the non-speculators and the speculators. And the non-specs are basically two categories. You've got the producers who, producers and industrial users. So producers, fabricators, refiners, whatever you like to call them. The producers basically are like gold mines. Now, what concerns the manager of a gold mine is that he's going to have enough cash at the end of the month to pay all his workers, or the end of the week, or whatever it is. So he will hedge his production forward so that he doesn't get stymied by the swings in the price. This is, it's exactly what farmers do. Farmers have exactly the same problem. It's more obvious, if you like, if you're farming wheat or whatever it might be. So that's one category of the non-specs. The other category are the swaps. And the swaps are mostly bullion bank trading desks. Not entirely, but the majority of them are bullion bank trading desks. And guess what? They're the same people in London who are in London. You're going to get the Basel III rules on the net stable funding ratio introduced in America on the 1st of July. So basically, both markets are going to lose that portion of the liquidity on the non-spec side. It accounts for 75% of the liquidity which feeds the speculator side. And the speculators are divided basically into three categories. You've got the money managers, you've got the not otherwise sort of categorized, and you've got the really small specs. So those three people, if suddenly they take a liking to gold, the supply through the COMEX futures market is going to be very restricted, and it's going to be just about non-existent in London, other than the mine supply and the scrap supply that's coming into the market the whole time. But as we know, that's a fairly small quantity. The potential effect of this on gold and silver markets is to take away, obviously, an awful lot of supply. I mean, we can see on COMEX that 75% of the supply effectively is going to disappear. This is paper supply we're talking about. Now, with paper supply disappearing, I mean, just put yourself in the shoes of someone who's got an account at a bullion bank. You're going to find that the bullion bank turns around and says, well, it was lovely knowing you and all the rest of it, but we're no longer offering this facility. So this is the value of your account, or you can move it somewhere else, but if we're going to pay you off at the end of the month at whatever the figure is, bang, piss off, sort of thing. So you can see that this is going to leave a lot of people very unhappy, and we don't know the size, the quantity of money involved. All we do know, going way back, is that at some point in the past, the LBMA changed their reporting from members' total positions to members' positions with each other. And at a very rough guess, people who were following it at that time reckoned that roughly 4/5 of the supposed turnover on the LBMA disappeared as a result of that change. So we're looking at a daily turnover of 30 million ounces between LBMA members, then we're looking actually at a settlement. We're talking about settlement at the end of the day. We're talking about 150 million ounces, including non-LBMA counterparties. So you can see this is a very, very big deal. It's a radical change in the market, and it's going to, I think, have two effects. Firstly, as I've described, it's going to limit the liquidity in the market very substantially. And the second thing is that I think you will find that quite a lot of people who thought that they had exposure to the gold price find they haven't got exposure to the gold price. And at least some of those are going to seek to replace it with a holding in physical gold. So it is likely over time to drive prices up. Now, in terms of timing, we've got these sort of what appears to be watershed dates, like, the end of this month and the end of this year. There is nothing that actually forces a bank to close its open positions in the market. It's something which they can continue to do, but there is a balance sheet penalty. So I think rather than saying that, it's like a curtain coming down, bang, like that, and suddenly the world's going to be different, we are evolving, and I think we are already evolving away from the situation where the market is dominated by what on COMEX they call swaps and what in London we call bullion banks. So I hope that sort of sets the scene for you. It also equally applies to silver, incidentally, which is a far less liquid market. It also applies to other markets such as oil. And interestingly, I don't know if you've noticed, but West Texas Intermediate is now up at about $73 or something. It's
exactly, yeah.
For a long time. So you can see that energy prices are already, I think it would be wrong to attribute the rise in energy prices only to this, but I'm sure it's part of it. And also you've got commodities like copper, which again, any of these commodities which trade on COMEX, the banks are involved in there providing liquidity. And if they've got a balance sheet penalty, which discourages them from doing this, then you can see that it's going to have the effect of driving commodity prices generally higher. The other thing worth mentioning is the position in derivatives. The LBMA don't regard, as I said, they don't regard their gold as derivatives. And I think they've fallen into a trap here because as far as the net stable funding ratio rules are concerned, derivatives are a different category. And in my reading of those rules, I think there is the potential for a little more flexibility if you define this as a derivative, insofar as you can net one derivative position off against another. And I think they've had to do that because the amount of outstanding derivatives, we're talking about $650 trillion equivalent. These aren't just sort of commodity contracts. They're also interest rate swaps. They're also forward foreign exchange positions. And it is enormous, absolutely enormous. So the treatment of that is changing as well. And this is something which is going to have potentially unintended consequences. Anyway, that's as much, I think, as at this stage I can tell you about the net stable funding ratio. And incidentally, the first Basel wasn't. We've had Basel I, Basel II, and this is Basel III. The first one wasn't running a hotel in Torquay.
Alasdair, a lot of people would say historically the banking sector and financial institutions have been known to be major influences in the suppression of precious metals prices. So there's the logical question from a lot of people would be, why would they agree to a policy that would increase the price of both metals, as you've just highlighted?
I think there's several answers to this. I mean, one's almost got to take a step back and look at an even bigger picture.
Yeah.
I mean, if we go back to the Nixon Shock, August 1971, President Nixon turns around and says, we are temporarily, this is 50 years ago, temporarily suspending the Bretton Woods Agreement. What the US Treasury then did as a matter of policy, and following that up, was to try and suppress the price of gold. Because it had the interest of promoting the dollar without gold backing as the world's reserve currency, compared with the dollar with gold backing as the world's reserve currency. And quite a lot flowed out of that. And there is no doubt that the Exchange Stabilization Fund, which was set up in the wake of the 1934 change in the value, the exchange value from 20.67 to $35 an ounce. Yeah. That Exchange Stabilization Fund undoubtedly was in the market, suppressing the price. Now, in the early days, they very quickly gave up selling physical gold in the possession of the US Treasury, simply because the market was saying, give me more, give me more. It wasn't actually suppressing the price. Yeah. It was just inflaming enthusiasm for yet more bullion. Then, of course, you had the development of paper markets. And this very early on was seen by the authorities in America as encouraging, if you like, the suppression of demand by deflecting it away from physical commodities into paper equivalent. So it's an expansion of supply without the supply actually expanding. And this, in the case of particularly gold, was seen to be a good thing in terms of monetary policy. It would put a cap on gold. Yeah. And the way the London bullion market first really got going in the early 1980s, or really middle 1980s, was that it was a carry trade. And what the bullion banks were doing was they were leasing gold from the central banks to sell into the market. They would end up with cash, dollar cash, which they then invested in US treasury bills. And they were paying 1 or 2% and getting 6 back. I mean, it's a lovely, lovely game. And of course, at the end of 6 months or whatever, you either rolled it or bought the bullion bank and flogged it on back to the lessor. And incidentally, one point about leasing is that the ownership of the property does not change in a lease. So this is very, very important. What happened was that over the course of the bear market, from the very early 1980s through to 2002, was that these positions accumulated and just got larger and larger. Because as far as the bullion banks were concerned, I mean, they could see that the price was going nowhere, it was possibly going down. So they also had a profit. If they hadn't hedged the volatility, or if they hadn't hedged the price, they would also have a profit on their gold, as well as picking up a yield by buying US treasuries with the proceeds. So much so that by 2002, the total leasing position was estimated to be anything between 10,000 and 16,000 tons. And all this leasing having come out of central banks. We don't know what the position is today, but the point is that is gold which is double counted, because it appears on the lessee's balance sheet, and it also appears on the lessor's balance sheet. So you can see that these games, as it were very important in terms of keeping the price of gold subdued and allowing the dollar to be established as the reserve currency, the hegemon for everything. And that indeed is where we got to. Now, there was evidence back in the wake of 2011-12, when gold last ran up to over $1,900, and then it sort of stalled a bit and you had the bear market. There was evidence of some very, very big sellers in the futures market in particular. And this, one can only assume, was either the US government acting in the market or its nominees in the form of the big banks operating in the market to try and keep the price suppressed. Now, these are the days of Bernanke. And we've moved on. We've gone through Yellen, and we now have Jay Powell. I think that as far as governments are concerned, they are now less concerned about what happens in the gold market. I mean, looking at it from their point of view, you've seen Bitcoin go through the roof, and Ether and all the rest of it, and you haven't really bothered to do an awful lot about that. If you start intervening in the gold market, then suddenly you're going to be making people think, hold on, perhaps gold is important after all. So the best thing is just leave it alone. And I think that's more or less where official policy is. Now, as far as the banks are concerned, of course, they've now been left with short positions.
Yes.
Because they are the side that has supplied, if you like, the retail market, the investment managers, and all the rest of it. They're the suppliers of it, and they've supplied it not by actually owning the physical gold, but by selling it short. And, from time to time, they will cover their positions, but they cover it not exactly, which is why this net stable funding ratio thing has messed up their game. I mean, they will take positions, particularly in the silver market, they will take option positions, out of the money option positions, say 2 years out, so that they're not paying a lot of money for insurance in case the price takes off, sort of thing. And then they can drop it on the short tack. So, they've been playing these games. Those games are now basically coming to an end. So in terms of what influence the banks had over these new rules, the answer is none at all. This was something that was cooked up at G20 level originally, along with the determination to do bail-ins and not bailouts, which is a separate question and actually an extremely dangerous situation if we go down that route. But the banks have really got nothing to do with this. And this is interesting because I am aware that going back in time, going back, sort of 3 or 4 years, there have been various meetings on this net stable funding ratio between the LBMA and the Basel Committee. From what I've learned by those present, they got absolutely nowhere. The idea that what we would regard as the establishment has any say in this, no, they haven't. And that includes the banks in particular. The whole idea is to regulate the banks, not to produce something which suits the banks.
The banks won't do too badly out of this anyway, I wouldn't think, if I'm on the right thought pattern here. Central banks have added another 69 tonnes of gold to their reserves in April of this year. It's 164 tonnes of gold in 2021. If the price of gold goes up considerably, then that's got to help their balance sheet, look at their balance sheet as well, doesn't it? So that would be good for the banking sector, I guess. That would be a positive.
In theory,
yes,
for central
banks, yes.
Very, very few commercial banks actually hold any gold. If they hold gold, it will be evidenced on their balance sheets, because remember, if they hold gold, it's got to be theirs entirely, and it's got to be there. Any customer's gold is either unallocated, in other words, it's mythical, or is held in custody. So, that is the point. When it comes to central banks, there has been some talk about how it suits central banks, but central banks, I don't think really have that problem. Central banks are in the business really of, in theory, controlling the expansion of the quantity of money which they produce. And This is always fiat currency. None of these fiat currencies are backed by bullion. Bullion is a completely separate thing. The idea that you need to have gold backing for your central bank only applies, and I'm not sure that this is really true, but it only applies to the national central banks within the European Union. Why? Because the national central banks are not the primary producers of euros. They are, if you like, subsidiary to the ECB, but they're not on the ECB's balance sheet. In other words, the production of currency has been taken away from the national central banks within the Eurozone system, the Euro system, so that under those circumstances, they can't just print their way out of trouble. All the other central banks can do that, and that is actually what they are doing, and have been doing with increased aggression, particularly over the last year. So, while it's very nice, I mean, if we thought we had 60, 70 tons of gold personally, we'd love to see the price higher. I'm putting it simplistically, yes. But a central banker won't look at it like that, that way, unless, of course, he's the Bundesbank, the Banca d'Italia, the Bank of France, and you don't want to shout about it because you don't want the politicians interfering at all. You want to keep that well away from it. I mean, it's like Macron at the G7 said, he made some comment that really, the central bank should be selling gold to help pay for vaccines for, Africans and so on. I mean, he was making exactly the same mistake that Gordon Brown did, when he sold half this country's gold at around about $250, $270 an ounce. And, I mean, as they say in Scotland, and this is probably appropriate, given that Gordon Brown came from Scotland, the man's an idiot.
I must admit, Alasdair, when I heard the French president say that, I think the IMF may have taken a dim view of that comment that he made, selling off.
Absolutely. I mean, the interesting thing, what you're saying there, is that, of course, it was the same Gordon Brown who, in the wake of the 2007 to 9 banking crisis, got the IMF, got everybody in the G20 to agree to tell the IMF, instruct the IMF to sell, I think it was 400 tons of their gold. And the idea was to, give money to the poor around the world, who are affected by this awful financial calamity. I mean, what a joke, really. I mean, people around the world, they continued with their lives as per normal. It was, it was the people in the financial system who were getting screwed. But and if I remember correctly, the bulk of the IMF's gold was actually bought by India, which was fascinating. And the rest of it was, So anyway, I mean, Gordon Brown and gold are two things that, just don't go together.
Don't go. Before we leave the subject of Basel, and because I want to talk about inflation and inflation figures with you, the question I did have, or the statement I had, and you came across it, or you're talking about it, but from now until June 28th, right, which is only a week and a half away, what do you expect the prices of silver and gold to do? Do you think there may be a slight rise, or do you think that the banks are just going to, or the dealers are going to balance the books, so to speak? Anything could happen?
Well, always anything can happen is the short answer, which is why I never make price forecasts. But no. I mean, what I would say, the one thing I would say, I've already pointed out that we're coming up to the quarter end, and not only quarter end, but it's also the half year end. And I've pointed out why the bullion desk traders would be very, very keen to get prices down as much as they possibly can. Now, I don't know to what extent they can manage to do that. The one thing that's interesting, I'm just looking at the volumes on COMEX, is they don't seem to be reducing their overall position that much. All they're benefiting from is a lower price rather than a lower contract exposure. So that's interesting. We'll see whether the hedge funds, who basically take a decision either to buy gold, sell dollar, or sell gold, buy dollar. I mean, they look at it as a pairs trade. Okay. They're not looking to take delivery or anything like that. It's a pairs trade as far as they're concerned. So they'll be sort of having second thoughts perhaps about the FOMC statement. And if I'm right about what that statement really said, which basically was nothing, I mean, it really was nothing. We all got terribly excited, or some people got terribly excited about the potential for interest rates to be moved forward from 2023, 24 to maybe 22, 23. I mean, actually, if you think about the statement that came out of the FOMC, all they were saying is, we don't think that the rise in prices at the moment is going to follow through. That is our default position, and we're not moving from that. But we will recognize that there's perhaps a little more risk in the situation to our policy than we first thought. But we still believe that next year, as production adjusts to the increased consumer demand, that prices will come back to normal. And therefore, we see no reason to raise interest rates unless that doesn't happen. And if that doesn't happen, then, towards the end of next year, perhaps we may have to raise interest rates. What sort of statement is that? It's telling you absolutely, all it's telling you is, look, we've got it right. You guys have got it wrong. We're not shifting. All we're doing is we're doing a bit of PR to make sure that we don't get blamed. Bang. That's actually all it is. It is complete nonsense. It is just, it's just public relations speak. It's not actually any indication of what policies are. So coming back to the hedge funds, if they wake up to this rather than think, oh my God, there's really been a seismic shift in the FOMC's position here, which I think is extremely unlikely, then what they're likely to do is to say, well, gold's fallen $100. The dollar's trade weighted has increased up by 2%, which it has over the last 2 days. I think it's time basically to sell dollar buy gold. I think that's probably going to put a floor under it. And I think the floor shouldn't be too far from here. But anyone who makes forecasts, I think, anything more precise than that is holding a hostage to fortune. But the way I look at it, there's a very serious point. If you are a buyer of bullion, just be aware of the reasons that you are doing it. You are doing it because the bullion is a sounder form of money than the fiat currencies that are being printed with gay abandon. And so what do you intend to do with your bullion? Are you looking to make a profit in dollars? If so, go and deal in the paper, because it really doesn't matter. Mm-hmm. If, on the other hand, you are buying bullion as an insurance policy against the world going horribly wrong in the monetary sense, and you want to have some money in order to survive following that, then you're going to spend your bullion at the end of the day. You're not going to swap it back for dollars, Australian dollars, US dollars, euros, whatever your currency is. And that, I think, is the vital point. It's very easy to slip into the thinking of an investor when it comes to buying gold. You think, it goes up $10, you go, hooray. It goes down $10, you go, oh, this is terrible. That is, it's completely irrelevant. Okay, if you own shares in BHP or something like that, then yes, you're watching what the institutions are doing. You're watching, the price of the commodities that they mine. You're looking at the efficiency of the management, and all these things. And you obviously get, quite paranoid perhaps about what's going on in the company, with justification, because this is an investment. And the point about an investment is that you have bought into the investment with the view to eventually selling it back into the currency in which you account your portfolio. So you can see that that is a perfectly normal investor reaction to worry about why is the price going up, or why is it going down, or whatever. Is there something I've missed, and all the rest of it? But when it comes to physical bullion, gold and silver, the reason you should be long of bullion is basically at the end of the day, you'll spend it. And so the price today, tomorrow, day after is completely immaterial. Absolutely. And I would say that if I'm absolutely wrong and somehow the central banks find a way out of this morass and they can return their currencies to stability, I would be the first one to cheer them on and say, well done. Because what we're talking about, the collapse of fiat currencies, is the most serious thing that we will ever see. Our fathers, our grandfathers, and our ancestors going back quite a long way, the most serious thing they have ever seen. This is an event which is not something that can be taken lightly at all. It is extremely serious.
Agree 100%.
Yeah, 100%. Yeah, I quite often in some of the talks that I do here in Australia, I ask the people who are buying silver and gold, do you want to buy trinkets? Do you want to buy gold for trinkets or treasures? And if you're buying it for trinkets, which might be another motor car, or might be a pair of water skis or snow skis, well, these are little trinkets. You buy gold for treasures, things that don't happen very often, but you've got it there for when it does happen. And that's the way I've always bought gold and silver, and that's why Darryl and I have always kept our gold and silver. We don't buy too many trinkets. We buy a few treasures, but they're very much a treasure. Alasdair, I want to move on. We want to talk a little bit about inflation. But before I read the first question, I'm going to read out a quote from our Federal Reserve Chairman, Mr. Powell. And the quote is this: "The recovery, although still incomplete, remains strong, with the real GDP on track to post the fastest rate of increase in decades." I would say that if you're going to print $6 trillion, or the government prints $6 trillion, yeah, you're going to have a fast rate of growth of GDP. So, when you read between the words or behind the scenes, what a ridiculous quote from Jay Powell. My question: the month of May, last month, this year saw the largest rise in food prices in 10 years, which was reported by the World Food and Agriculture Organization. Now, with the trillions of US dollars being printed, how long will this inflation be around for, and what is the end game?
I mean, the answer basically requires an understanding of what inflation is. Inflation is an increase in the quantity of money in circulation. I mean, it's as simple as that. It is not the evidence. I mean, rising prices is as spots is to measles. When rising, if you compare rising prices with with what inflation really is, it is unfortunately a growing mistake that even economists make now to confuse the two. They seem to think that inflation increasingly is rising prices and has got nothing to do with money supply. They're encouraged slightly in this because if you increase the quantity of money, the relationship between the increase in the quantity of money and prices is not arithmetic. I mean, it's not sort of, a given quantity of an increase in the quantity of money is going to give you a given change in price levels. In this sense, I think that monetarism is half right. I mean, obviously, there is a link between the quantity of money and the effect on prices. But to try and quantify it in the form of an equation, which is called the equation of exchange, which was first put forward by the economist David Ricardo back in about 1810, 20, around about then, is a mistake. And so, and also the idea of velocity of circulation, that is also a huge mistake. Velocity of circulation is completely irrelevant. And I'll explain why. We all go out to work to produce the money to buy the things we need. Okay, what's the velocity of circulation of our income? It's 1, because basically we earn the money and then we spend it. And over a year, our total income, maybe $50,000, we spend it. That is a velocity of 1, and it doesn't change. I mean, some of that we will save, which is in effect deferred spending. So it gets spent another way. It gets spent through companies investing in production, for example. So, and this comes back to your basic point, actually, about GDP. The idea that GDP is growth is complete nonsense, because if you understand that everybody works in order to earn the money to buy things, and incidentally, as a subset of that, to pay the taxes for the government to buy things, then on that basis, GDP just doesn't change unless you print money. If you print money, you can fill a gap and bolster GDP. So that is where money printing comes in. So the basic point that you were making is that when the Fed prints an awful lot of money, which they have done, I mean, it's just staggering, the increase in the quantity of money they've injected into the economy, then the effect of that, undoubtedly, is the nominal value of GDP will increase accordingly. And that obviously assumes that the money is spent on things which are included in the GDP. Some things are not. For example, second-hand goods are not included in it. Money which goes into the finance sector and is invested and doesn't actually come out of there, doesn't necessarily. But that's a tricky one, because if you're going to go in and buy shares, you're going to buy them off someone. What does that someone do with the money? They spend it, probably. It does end up getting spent, so it just delays the transmission of it. The only offset to that, Powell, you quoted Powell as saying, real GDP. Now, if you suppress the apparent rate of inflation by monkeying around with the figures, so that you're always at 2%, then the idea that the real GDP is something real, realistic, is obviously nonsense. So, the idea that real GDP is very different from nominal GDP, forget it. Nominal GDP is the one which, as far as governments are concerned, they're interested in, because that is the basis of their tax collection. GDP tells a government how much tax it can collect. And that is why GDP is so popular with the state, and why we should ignore it, incidentally.
Why is silver? Why are silver and gold the most dominant resources for hedging against inflation? Why not nickel, copper, aluminum, or wheat? Why is silver and gold the important issues here?
The answer is that when barter came to an end, it came to an end because people found something that they mutually wanted or desired, which they could exchange for goods, so that that item could act, if you like, as a holder of value. And it didn't require you to immediately swap, let's say, the wheat that the farmer produced for, the horse that he wanted to buy, for example. He could actually hold on to, whether it was cowries or the stones of yap or whatever it might be. I mean, he would have that, or he would have something indicating that he had it, which he could then spend later. And obviously, different civilizations, they took different things. But the one thing that really worked from the very, very early days was metal, because metal is durable. You can weigh it. And there were 3 metals in the early days which were used as money. One was copper, second one was silver, and the last one was gold. And they sort of ranked in that order, if you like, in terms of desirability. Gold, obviously, I mean, I don't know if you've ever been to Cairo and gone to the Cairo Museum and seen Tutankhamun's mask. I mean, that was made, 3,000 years ago. And you look at it and it's like yesterday. It is absolutely stunning. It is beautiful. I mean, this is something that you really would desire. And not only that, but its durability is so obvious. So you can understand why gold, if you like, has those characteristics which can be used. And it wasn't just the ancient Egyptians. I mean, the Greeks were the same. And then when you come to my country, which is the United Kingdom, I mean, going back, the Celtic art, which used gold and silver, very often in combination. And we've got artifacts going back 2,000 years, which are just absolutely staggering in terms of their beauty, the skill of the artists in putting these things together, like the Snittersham Talk, for example, which weighs something like a kilo of gold and silver, which is called electrum, was in the past. And then you've got, if you go to one of the museums in Oxford, I'm trying to remember the name of it, but you've got the Arthur Jewel, and this was found in a bog in Somerset, not very far from where I live. And this was the sort of thing that went on the end of the pointer, and it had an inscription on it: "Arthur had me made. Arthur me fecit," in Latin. And this is gold and crystal. And you look at this, and you think this is incredible. So, I mean, I've taken examples of gold 3,000, 2,000, 1,000 years ago, and the durability of it, the desirability of it, is the same the whole way through. And then the discovery of the New World, we got exactly the same thing happened there. They found that the desirable things were both gold and silver. They weren't necessarily being used as money, but you can see that they were mined, they were produced, and they were valued, treasured even. So there is something, if you like, in man, which requires the durability of gold, silver, the durability and desirability of gold, silver, and copper in that order. Now, copper has sort of rather dropped out of our consideration, but silver is still there, even though central banks don't own it. If I'm right, and this era of fiat money is going to come to an end, it always has in the past. So we've yet to find a good reason why it won't again. Then silver, along with gold, will become the people's money. And particularly silver will be the people's money, because that is, if you like, an easier and more abundant form of money to carry around, because we've all got silver in one form or another. And at current prices anyway, silver is perhaps more accessible, if you like, than gold. But having said that, I think that the relationship between these forms of money will change, and they could change considerably. And I think very much in silver's favor, because, in terms of above ground stocks, there isn't that much silver. The monetary value of gold, I think we're looking at no more than about 80 to 90,000 tons of gold, which is actually monetary gold. The rest of it is jewelry or whatever, and has to be converted into monetary gold. So going back to your trinkets and...
trinkets and treasures. Yeah. Alasdair, to finish off with my question before Darryl finishes off himself, on the subject of silver, as good as gold makes its own silver and gold, or we have our own gold and silver bars refined, but reference to silver, we have at the moment a 4 to 6 week delivery on sizable orders. We an order for 1, 2, 3, 4, 5, we deliver in 3 or 4 days. Sometimes they're off the shelf. But when you have a customer that actually orders a significant amount, those sizable orders take 4 to 6 weeks. I'm looking at, can you describe what it could be like when more people are drawn towards buying silver for a hedge against inflation? So obviously there's only a very tiny amount of people buying silver at the moment, right? It's like gold, it's less than 1%. Now we're doing 4 to 6 weeks delivery on sizable orders. What do you think is going to happen when people actually catch on to what fiat currency is really destroying us, and they want the silver and gold?
Well, I think the result is quite clear, and that is that the delivery dates are going to take much longer. And not only that, but the importance of these Basel III changes is that the amount of liquidity in the market is also going to suffer hugely. And already, certainly in London and reports that I hear from America, there's very little physical around. And you're just echoing a story which is everywhere. If you want anything in any size, join the queue. I suspect also that the big Chinese banks have been in the market buying gold. I don't know what they do with silver. I haven't looked at that too much. But when it comes to them buying gold, I guess they go direct to the refiners, or they go direct to the mines and they buy doré and refine it back at home. So there's probably not as much supply, fresh supply coming in as you would think. So what we would need, I think, is a real jump in the price in order to attract scrap. Now, that's what happened back in the run-up to the all-time highs back in 2011-12. Scrap supplies increased substantially, particularly for silver. An awful lot of really valuable silver was destroyed by that process. I mean, when I say valuable, I mean in the artistic sense. I think this time it would probably take a bigger jump to generate the same amount of scrap supply, because in these current monetary conditions, I'm not sure that people will part with, sovereigns and sort of coins, silver coins, and so on, quite so easily for refining. I think they'll probably be more inclined to say, well, perhaps we ought to hold on to this this time around, because I mean, it's this has happened to them once before. And not only that, but one of the big lessons from cryptocurrencies is that people are a lot more educated about what central banks are doing. And this is actually, at the end of the day, going to undermine the central bank's game. It's bound to. And so I would posit that anyone who's got, let's say, that nice piece of Georgian silver or a few sovereigns, in the bottom of a drawer somewhere, is probably going to hang on to them more than he would have done in the past. So I think supply is a real issue. It's not there. And I think there could be a moment where we decide, look, either you've got it or you haven't. And if you haven't, tough. I mean, can you imagine trying to buy gold with the price, say, jumping hundreds of dollars at a time? I mean, this is the stuff of nightmares for investors. It really is, because they're being shut out of the market. And I would say anyone who has an investment approach to this, serves them right, because they don't actually understand why they should be buying gold and silver. They should be leaving it for those of us who actually do. That's a bit selfish. I don't really mean that, but because for goodness sake, people, get your act together. Understand why you're doing this. I think that's terribly important.
Yeah. Now, if there was ever a time to make a decision to buy physical metal, it's got to be now, because Brian's right. The deliveries are going to go way out, or maybe you won't even be able to get it at all. Don't know. But now's the time. Alasdair, I really loved your comments before about why one should be buying bullion. And if one is thinking about a return on their investment tomorrow or next week or next month, gold and silver are not for them. But gold is all about, and silver are all about, protecting your wealth. We've mentioned this, Alasdair mentioned this, protecting your wealth, store of value, hedge against inflation. It's just a shame that so many people don't do a bit more research, and there's plenty of information out there. Alasdair Macleod presents beautifully, and you've only got to recognise that and say, I'll follow this gentleman. I'm going to learn as much as I can from him. Charlie Jones said that years ago. The people you meet in the books you read. Well, here's an opportunity for people. No excuses. You've got people like Alasdair Macleod who just provide a wealth of information. And I'd like to share this with you. I could believe it, but It's typical of what's going on in mainstream media at the moment, Alasdair. On TV the other night, television, we had a house that was, the promoters were saying this house sold for $14.3 million in one of the really sophisticated suburbs in Melbourne. And it was a record at 14.3. They asked the owners what they paid for the property and how long ago was it that they purchased it. And the answer was, we purchased it just over 40 years ago, and we purchased it for $1 million. Now, the mainstream media representative said, wow, what an investment was that? And they said, yeah, we know, we're really excited about it, but the people who are moving here to getting a wonderful home. Well, let's think about that for a second. So 1 million to 14.3 over 40 something years. Sounds good. What they didn't mention, and they never mention, is the interest paid on their borrowings, on that mortgage, the stamp duty factor, it's never brought into the equation, council rates, water rates, ongoing maintenance and renovations. And my guess is that all of that would probably represent another $1 million. So it'd be something like $2 million. So in fact, the property went up around 7 times. So the investment or return investment, something like 7 times their original investment over 40 years. I looked at gold, Alasdair. 1975, 76, we're going back 44 years, thereabouts, 45 years. Similar time frame. Gold was $100 an ounce Aussie. Today it's 2,400. It's up 24 times over that 45-year period. That's something like, about 3.5 times the return on the property that everyone was raving about. Now, you could take it a step further and you could go back to 1971, 72, where gold was at $35 an ounce, so you'd be up 70 times on your original investment. It is indeed a shame that more people do not research and know and understand and come to grips with what we've been sharing tonight. So, by the way, with gold, Alasdair, as you and I would both know, the only costs incurred in owning that gold would be that of vaulting, if in fact you decided to do so. If you decided to hold it at home, well, you could do that, and it would cost you nothing. Let alone, of course, where silver is heading over the next 1 year, 2 years, 5 years, it may very well outperform gold by double. So, I mean, over the long haul, gold and silver just outperform everything.
Yeah, because everybody talks about real
very
estate.
misunderstood subject. Would you like to add any comments to that, Alasdair?
Yes, I would. I mean, what you say is spot on. I mean, funnily enough, it was only this week I did the exercise about my own house, which I bought in 2007, and I found that we had an estate agent around here looking at this recently, and it'd gone up on average just under 5% every year, compound, obviously.
Yes.
But the price of gold had risen 21% every year over the same period.
Yes.
But I think a better way of looking at what you were talking about is to turn the equation the other way up. And that is that measured in gold, I can't talk about Aussie dollars, but it won't be too far different. But measured in gold, the US dollar has lost nearly 99% of its purchasing power.
Exactly.
And that tells you everything you need to know.
Yes, it does. Yeah, perfect.
That's obviously from $35 an ounce, which was, as you say, 1970, 71. Yeah.
Alasdair, look, an hour, we breezed through an hour there, and it only seems as though it was a few minutes, but really enjoy chatting with you, and your information is invaluable, and I'm sure our viewers and subscribers feel exactly the same way. I know that as I mentioned, Charlie Jones, it is the people you meet and the books you read. And if you're prepared to dissect that information and take full advantage of it and act upon it, you're going to be much better off for it. So thank you again for your sound information, Alasdair. Really appreciate the time and the effort you put into supporting As Good as Gold Australia and working with us as you do. Thank you again. We'd also like to thank our viewers and our subscribers. They support this channel, have been doing so for many years now. We really appreciate your support and would like to say until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.